Today, I'm going to share with you 4 different things that help determine your mortgage rate. Now, if you're looking to buy a home in the near future, you're probably hoping for the lowest possible interest rate that you can obtain. Now, over the past couple of years, that has been very easy as we're sitting at historic lows. But now, dramatically, those rates have come way higher than they were previously, and that is causing a lot of heartache for buyers hoping to buy a home. So hopefully these 4 different tips will help you navigate that process and get the lowest rate possible. I do suggest you connect with a local mortgage advisor as soon as possible, no matter what your horizon is in purchasing a home, because they can shed some light on what needs to happen and what your options are in getting a lower interest rate. So the first factor here is your credit score. Your credit scores can play a big role in your mortgage rate. In fact, Freddie Mac explains it like this: when you build and maintain strong credit, mortgage lenders have a greater confidence when qualifying you for a mortgage because they see that you've paid back your loans as agreed and use your credit wisely. Strong credit also means your lender is more apt to approve you for a mortgage that has more favorable terms and a lower interest rate. So, number one, get the credit score sorted out. It can take some time. So even if you think it's going to be a year or more, you want to address that as soon as possible, because it could take a couple of months, maybe longer, depending on your situation, to straighten out that credit situation. Number 2 is the loan type. There are many types of loans out there. For instance, we have conventional, we have USDA, we have FHA, we have VA loans, and all 4 have different requirements for qualification, and they can have a different interest rate. They all have different interest rates that come with them that will significantly impact your monthly payments. So knowing which type of mortgage loan you're likely to be facing is going to help you not only with the payment. It's going to help you determine which type of home that you're searching for, where you're likely to find that home in your marketplace. And then the third item here that helps determine your mortgage is your loan term. Historically, 30-year fixed is what a lot of people go for, but you could also consider a 15-year fix, and depending on, again, your situation, how much you're putting down, it might make sense to go with a shorter term. If you can do a shorter term, this typically results in a lower interest rate. So 30-year fix, typically a little higher interest rate, or a 15-year fix would see a lower interest rate. And the fourth and final factor that helps determine your mortgage payment is your down payment. How much can you put down? If you own your own home right now, and you've owned it for 2 out of the last 5 years, you can take 100% of that equity that you take from selling your home and make that put that towards your down payment. In general, if you can put 20% down or more, that will have a significant impact on your mortgage interest rate, and often will require the lender, or the lenders will offer a lower rate because they see it as a less risk. You have more skin in the game, you have more equity, you are a lower risk for default, so therefore they can offer you a lower interest rate. And so really the bottom line here is preparation overall. Get with a trusted advisor, get with a trusted local lender advisor, work out a game plan to put you in a winning situation to get a lower interest rate before you go out and start shopping for a home, so that you're ready. So if you have any questions, let me know. I'm here, and I'll see you in the next video.